So hello everybody, and I hope everyone is doing well. So this is chapter 6 on interest rates, okay, risk and return, and I basically want to pick up where I left off the last time. So this is interest rate fundamentals, okay, and basically what's important here is how does one determine the risk-free rate of return? Okay, the risk-free rate of return is the return paid on treasury securities because they're always going to pay you, right? This is the risk-free rate of return. How do we determine that? We just take the real rate, which we previously discussed, which is R star. So remember, the real rate is R star, and we add the inflation premium to that. Okay, so this is equation 6.2 in your book. So here's the inflation premium. Okay, so the nominal rate. So how do we determine the nominal rate? The nominal rate is simply RJ, and that's defined as this risk-free rate right up here. So this gets pulled down right into here, plus the risk premium above the risk-free rate for investments. So this is the term that gives you the risk premium for anything else except government securities. Okay, so this is if a bond is in default, or a company's in default, or even any corporate bond, anything above and beyond the risk-free rate for a treasury security is shown by that equation. Sorry about that. All right, so this shows the inflation rate and the treasury bill rate as they somewhat move in unison. So you'll notice here in 1981, which was when I was trying to buy a house, in this period, you notice the inflation rate was huge. It was around 13 or 14%, but the treasury bill rate was, kind of right up there. So you could have got a good return on your money, but however, you just got barely more than the inflation. So, and they're showing you here what was a positive real interest rate, right, and what was a negative real interest rate. So that's what these colors are showing. And you can kind of see here's the inflation, and here's the treasury bill. So you can see you have a negative real interest rate here. And here, and different periods, there were negative real interest rates. All right, so the yield curve, the government puts out a yield curve, and that determines the interest rates over time for different treasury securities, starting out with like 1 month and then going up to 30 years, right? So what it is basically just a graph of the term structure of interest rates. And there should be one in the book. So there's a nominal yield curve, right, which they show, and it's upward sloping. For a normal economy, you'll have an upward sloping curve, and that indicates that long-term interest rates are generally higher than short-term interest rates. And when it inverts, which means we're heading for a recession, which we might be doing right now, by the way. I think I may have sent you some stuff on a recession or a depression. Things are really bad, financially. And so this basically, an inverted yield curve basically indicates that we're going into a recession. And a flat yield curve, which basically when interest rates aren't varying much, indicates that interest rates do not vary much at different maturities. Okay, so there's 3 types. There's a nominal, an inverted, and a flat. And here they are, right? So here is basically an inverted yield curve. And here is, positive yield curves. You see how these are going up. And this is, this one here is somewhat flat here, a little bit, right? But this one starts out at 5 and then goes down. So this is, a recession right here. Even this one is a mild recession. Both of these are mild recessions, right? You can see them here and the dates. All right, so the yield curve, if prices are falling, we're in a period of deflation, right? But people look at this yield curve and it affects companies' financing decisions. I sent you a thing about how they look at the price of copper and corrugated cardboard and JOLTS to determine when to make investments. So if you have a downward sloping yield curve, right, basically people may take advantage of those cheaper long-term financing. Okay, so financing is down, so long-term, and that's what an inverted yield curve is. Things are cheaper long-term than they are short-term. So basically, these gray bars indicate recessions, right? And also they indicate a recession falls in line with a inversion of the yield curve, right? So here's the periods, right? Here was the big one in 1980, and here was the great crash in 2008, right? When the housing market crashed and mortgage-backed securities, subprime mortgage crisis went on right here, right? So here, so this is what's being showed here. And there's a nice little thing here about on 2016, the 10-year Treasury note yield reached an all-time low of 1.366. And as you know, you must be hearing, if you're watching the news, Treasury bonds are down, 10-year Treasury bond, and the Fed fund rates are extremely low now. They're trying to keep the economy going. So, and the Fed's got more weapons in its arsenal. So basically the term structure is, there's a theory called the expectation theory. And the expectation theory simply states that the yield curve reflects investor expectations about future interest rates. So an expectation of rising interest rates results in this upward sloping, and an expectation of declining interest rates results in a downward sloping yield curve. So I don't know if it inverted now, or you can look at the current yield curve online and see if it inverted. So I'll go over this example. Suppose that a 1-year T-bill currently offers a 3.5% return and a 2-year Treasury note offers a 3% return. Thus, the short-term rate is higher than the long-term rate and the yield curve is inverted, right? According to the expectation theory, what belief must investors hold about the rate of return for a 1-year T-bill as far as being offered next year? First, recognize that purchasing the 2-year note, investors can earn a return of 6.09 over 2 years. And you can see that right here, right? It compounded, right? Everyone sees that's compounded. It's not 6, it's 6.09. If the market is in equilibrium, then the expected return on a strategy of purchasing a sequence of 2 1-year bills must offer the same return. So we have this basically, it has to equal the 2-year return that we calculated, right? So if we look at this, and then we have a new one here, so we calculate this return here, and it comes out to 2.5%. So one is going to be 3.5, and the other one's going to be 2.5. Again, they have to equal that 2-year return. I hope everybody understands this math here. So here's the 2 1-year returns, and previously we did a 2-year return.